In this video session, we're going to look at various cost concepts, the concepts of fixed, variable cost, and average fixed cost, total fixed cost, and variable cost can also be split into total variable cost, average variable cost, and then also marginal cost, and then total cost. So various economic concepts or cost concepts that we're going to discuss, as well as how to calculate it. And there's various formulas for this. So I can ask you in the exam or in the semester test to calculate all of this cost, and you just need to apply then the formula. But firstly, you also need to know, what does this the concept mean. So let's start off from, when we at the beginning, there are fixed costs and there are variable costs in production. So these are the two main, components or elements of production cost. Fixed cost, which is then, in relation to fixed inputs, like for example, the rental that you have to pay for factory or land, that remains constant. So that is fixed irrespective of how much you produce or what your output is, right? So that cost doesn't vary with output. And then variable costs, as you can see also on the slide there, costs that vary with your output. So cost that is associated with variable inputs. Say for example, if you increase salaries, your labor is your variable input, then it means that your variable cost will increase as you produce more. So as you produce less, then it will decrease with your input. So these are the two main costs that we have, fixed and variable cost. Now then also the other one is total cost. What is total cost? It's your the two together, that is your total fixed cost plus your total variable cost. So this is total cost. Now when we're going to analyze cost and the cost concepts, we first going to focus on TFC and then we move to TVC. So let's look at TFC. What does TFC consist of? Your total fixed cost. And you can also look at your in your textbook there, the definition of total fixed cost. Basically, what does it consist of? Now, total fixed cost, you use total fixed cost because that is your part of the cost that is fixed irrespective of your output. So TFC, basically, that is part of your total cost, and you can go further to that, and then you can calculate what we call the AFC. Now, what is the AFC? The AFC, if you look at the formula for AFC, that is your total fixed cost divided by the quantity of output, right? So you get your total fixed cost, which remains constant irrespective of your output, and then from there you can calculate average values for all of these cost concepts. So what is your average fixed cost? That is your total fixed cost, which remains constant, and divided by the number of units, right? So say for example, you have one machine, right? Just an example, if you have one machine, and to rent that machine costs maybe 1,000 per month or whatever, so that is your fixed cost. So in total, what will be your fixed cost? It will be 1,000. Now that will remain the same, right? So if you calculate your, say your total fixed cost, say that is 1,000, and the number of units that we produce, say for example, is say for example it's, let's look at your total fixed cost is 1,000, and we say 20. So what will be your AFC? Is 1,000 divided by 20, right? So that will give you 50. So that will be your AFC if your output is 20, right? Now let's look at further example. Say for example your total fixed cost will remain the same, but what will happen with your output? Your output will increase. Say your output increase from 20 to 50. Now if you divide 1,000 divided by 50, that gives you 20. Okay? So 20 is now your AFC, where it was, when you produced 20, it was 50. So what you will see with your AFC is that, because if you look at the formula of AFC is equal to TFC divided by quantity, what will remain constant all the time is your TFC. But what will change all the time is your output level. So what we have seen now, it decreases from 50 to 20. You will see as we produce more, as output increase, what will happen with your average fixed cost? It will decline. It will decline continuously, right? Although your TFC remains constant. And we can look at maybe just to explain it in terms of your curve. Your TFC, this is TFC, right? And this is 0, and this is your output. Now, we saw in that previous page that the TFC is 1000 for the machine. So it means that this will be your TFC curve. At 1000 it will remain the same, irrespective how much you produce. If you produce Q1, Q2 or Q3, TFC will remain constant. But that is not the case with or with AFC. What will happen with AFC? As we have seen, as you produce more, AFC will continuously decline. So that is AFC 0, that is your output. So your AFC curve will look like this, right? It will continuously decline as output increases. Okay? So this is the first one that I wanted to look at. That is your total fixed cost, and out of that, your average fixed cost. Now the next one is we also get your total variable cost. So that is the cost associated with variable inputs, right? Like labor, electricity, etc. that changes as you produce more or less. So say for example, your TVC, let's just take an example. You've got 3 workers and you maybe pay hypothetically 20 Rand per week or per hour. What will be your TFC? It will be 60 Rand, right? Okay, just a hypothetical figure. Now out of that, say for example we employ 4 workers, 20, then what will be your TFC? TVC will be 60, so it increases there with the amount of labor that you employ more, right? So TFC will increase as the cost of the variable input increases as well. So what is your AVC? That is the average variable cost. That is your total variable cost divided by the quantity, the number of units that you produce. So if your, say for example, if your TVC is then 60 and your number of units that you produce, say for example, is 10, then your average variable cost will be 6 Rand per unit, right? So that will be your AFC. And later we will come to the, the relationship between the marginal cost curve and the AVC curve. And when we deal with perfect competition, monopolistic competition, the significance of the AVC curve is very, very important in terms of the profit maximization of firms operating in this structure. So if you look at your AVC curve, that is AVC on the vertical axis and then quantity of output, and then your AVC curve will have this kind of shape. It will be declining, and then it will reach a minimum point, and then it will start increasing as you produce more. So at the beginning, as your output increases, it's declining, and then it reaches a low point, a minimum point, at a certain level of, say, output, Q3, and then if you produce more, then what will happen with your AVC curve? It will increase. So this is the shape of your AVC curve, which is very, very important in terms of future chapters. So that is AVC. And then we get remember, we looked at the beginning, total cost consists of total fixed cost plus total variable cost. And we looked at total fixed cost and total variable cost. Now we need to look at TC. Now, TC is your total cost of production, right? So from this, we can say, for example, the TFC is 500, and your TVC is 1000, then your total cost will be 1500. Okay, now from TC we can then calculate the average value of the total cost. So we can then calculate what we call ATC. Now what is ATC? Is the average total cost. Now simply stated, this is the cost per unit. How much does it cost to produce 1 unit of that product, right? And this is very important in terms of the following chapters. So that is your ATC. There's an alternative way of calculating ATC, is that your ATC basically will be what? will be your AFC plus your AVC. This is an alternative way of calculating your ATC. The other way in terms of a formula of calculating ATC is what? You take what? Your ATC, if you look at your example there also in the textbook, your ATC basically is what? It's your total cost divided by the number of units that you produce. That is your ATC. So if your total cost was 1,500 and you produce 100 units, then you just divide the two, right? So then it will be, ATC will be 15 Rand per unit. And this is very important for producers. They want to know how much does it cost to produce 1 unit, because they, based on this figure, they will then decide how much profit to add and what their profit they want to be, right? Okay, so they need to be able to determine what does it cost to produce 1 unit of the product, and that is outlined in ATC. Now the last concept, which is also important, critical for the following chapters, is your marginal cost, your MC. Now what is MC? Marginal cost simply means the additional cost, because marginal means additional, is the additional cost. If you can look at the slide there, is the change or the additional cost that results from a change in output. So it means that if you increase your output, what will be the additional cost of increasing that output? So it's a change in TC because of the change in Q, in output, right? So what is the formula to produce or to calculate MC? Is the change in total cost divided by the change in the number of units that you produce, right? So that is you know, how to calculate you know, MC. We can look at maybe if TC increases maybe from 40, just a simple example, to 45. So what will be the change in TC? From 40 to 45, so the change in TC will be what? Will be 5, right? Okay, so that is the change in TC. And if the number of units increase, say for example from 100 to 101, right? So the change in units from 100 to 101, that will give you 1. The change in quantity, and the change in TC is 5. So what will be the marginal cost, the additional cost of producing that additional extra unit? It will be 5, right? So this is how you calculate MC, right, in terms of that formula. But remember, I mentioned in the previous page as well, on the previous page, there's an alternative way of calculating ATC if you know what is AFC, or if you know what is AVC. Even if you know what is ATC, and if you know one of this cost, then you can calculate you know, ATC as well. Or basically, if you know both this, you can calculate this. So this is an alternative way of calculating ATC. But normally we use this formula in terms of marginal cost, right? So yeah, that is the ATC. Don't forget, that is the alternative way of calculating ATC. But in terms of marginal cost, you know, this is the formula that you need to use. There's no alternative here, just to compare the two. So, you know, this cost, what we have looked at now is the various cost concepts that is important. We look at, just to summarize, we look at calculation of TFC, we look at TVC, but from here we calculated what? AVC, we calculated what? AFC, and then we calculate AVC, you know, AFC and AVC, and then we also calculated what? Total cost, the concept of total cost, which consists of total fixed cost and total variable cost. And then we also calculate ATC. ATC basically is the average cost per unit. How much it costs the producer or the firm to produce 1 unit. And this is very important. And then lastly, we calculate the marginal cost of production. And the marginal cost is a change in total cost, the change in total cost divided by the change in quantity. So that means basically what is the additional cost that you incur by increasing your output by, you know, by a certain amount of units. So please, there are, examples there in the textbook, and there's also, a question at the back, question and problems, which you can work out, filling in the missing values, and that is important, working with numbers and graphs. Question 1, determine the appropriate rand amount for each lettered space. So this table is very important in terms of the exam and the semester test, and you must be able to calculate all of this cost. So what is important is the concept, what does it mean, but also the formula to calculate this various cost. So I just summarize, the various costs that we've dealt with. TFC, AFC, TVC, AVC, total cost, and then ATC, and then marginal cost is the last one there. Okay, that concludes the various cost concepts and the calculation of it, right? Thank you.